Evening, everybody.
Would you like some water?
This is the part of the evening where we have a panel session from each of the 4 companies represented here tonight. I think it's worth considering there's probably over 150 years of experience sitting around the panel tonight.
Ooh, that's cool.
So I'll let you do the maths. More interestingly, it's a great cross-section of different companies with different stories, whether they be from North America or Europe. Also companies who are at different stages in the value chain, from very early stage type work to more advanced evaluation type scenarios as well. And a slight range of commodities from base and precious metals. So you've got a real mixture here on the panel tonight. And I thought what we might try and do, and I'm still plugging the booklet, is I would go in order that it's in the book in terms of the questions initially. And I was going to ask Balmoral, Midas, Corvus, and Mundoro, their chief executives who are up here with me, a question just to get things rolling. And once they've each answered those questions, open it up to the floor where you may have very specific questions you want to ask anyone on the panel or any of the specific companies here tonight. So if that's all right with you, we'll kick it off. And Darin.
Good evening, sir.
Balmoral Resources. I mean, I look at this and see, Abitibi, great pro mining, Quebec, 2 discoveries, 1 precious metals, 1 polymetallic. Tell us a little bit about those and how you differentiate them within your portfolio.
Absolutely, it's actually a nice problem to have, to straddle the space, because for the investors, you really provide with the new nickel discovery, nickel copper PG discovery. And by the way, you did a fabulous job of giving my nickel copper PG pitch for me, because what you were talking about earlier is infinitely familiar. But it gives that hedge across into the nickel space where we do see very positive things in the near term on the supply-demand side across for the precious metal investors that are in the company, and vice versa back across the other way. And with both of them sort of being in the discovery delineation phase, obviously it's sort of the sweet spot in the value curve, and that's shown in the way the share prices behave this year. But it's also the exciting time for those of us that are explorers. You've really got, you're opening up two new district scale plays at the same time. Like you discussed earlier, the nickel things rarely in this type of system rarely occur in isolation. So we've got 20 plus kilometers to play with there. And on the gold side, we still have no concept of the scale and size of the gold system out there. So, and with all that dirt sitting on top of it, it leaves you plenty of dreaming rooms.
Great.
Good for the exploration crowd.
Thanks, Darin. That was a really good answer. I move on to Midas Gold now. So we're leaving Canada and we're going to Idaho. And what I was really interested about this is your strategy of actually putting together a significant land package in a past producing district. If you could maybe talk us through the strategy of that for Midas. Yeah.
Sure. So basically our approach here was that this area had about 1 million ounces of past production, but it had all been scattered small little pieces here and there. And we just felt that really this was one big deposit. But the challenge was all the owners owned these little packages. There were upwards of 13 different owners in the area, but even their pieces were broken up among each other. And it was a bit of a Hatfield-McCoy type situation, like they wouldn't let people drive over their property, and so there were all these isolated patches that you couldn't get to. And what we saw was ore bodies basically going right up to property boundaries, and then it stops. Well, that's not geology, that's ownership. So essentially our approach was, took advantage of the 2008-2009 financial crisis. Suddenly everybody's very motivated to turn everything into cash. We went around and we tied up the entire district, all 13 different owners, and for only about $1 million up front and about $6 million in total, bought out this entire district, which now has 6.5 million ounces of gold, and has a study that says this will be the 4th biggest gold mine in the U.S. when it's in production, and it's very good grade. It's about double the average grade, so it hits the points you said of grade, size, and that concept. So that's essentially why
Great.
it was successful, being able to consolidate all of that ownership.
Thank you. That was a really interesting answer. Jeff. Jeff's an old buddy of mine. We spent a number of years working for Anglo American or Anglo Gold, so I probably know a few stories I shouldn't, but that's not what we're here about tonight. What I'm really excited about is I visited the old Bullfrog mine when it was run by Barrick back in the day. I'm sure you did as well.
Yep.
And I'm reading about this new high-grade northern Bullfrog discovery. Could you tell us a bit about where that is and what's happening?
Sure. With exploration, it's one of those things, as you pointed out, Graham, you try and get yourself in the right area. You conduct diligent, exploration, good observations, and, if everything works right, you get a discovery. At North Bullfrog, it was about 10 kilometers north of the old mine that Barrick had, 2.5 million ounces of production, under $200 an ounce. It was a great mine, made a lot of money for Barrick, and we really wanted to find another one. We got out in the district, acquired the district, staked the ground for the most part. It was all open at the time. And Barrick had the ground and dropped it after they closed the mine. So we got out there and did a pretty diligent program, defined a big low-grade system. And as we were drilling that off, we began to understand a little bit about the structural fabric of the area and where the gold was coming from, and found a high-grade vein system, which looks like it's going to be another Bullfrog. So currently right now, about 1 million ounces in there, but we think we can grow it pretty quickly. So that's a typical discovery history. It's wonderful. It's the time of in a company when everybody is super excited, when you're right on that curve where Darin is, and you really get to go after something, and it's great.
Good head frame exploration in a prospective terrain.
Yeah.
And last but not least in this part of the session, Theo, I also was lucky enough to spend some time looking through Eastern Europe when I lived in Budapest in Hungary. And a lot of people probably don't know how rich the mining history is in Serbia, but also some of the great deposits that are already known, as well as some of the more exciting discoveries. So maybe you could talk the audience through Serbia and why there.
Serbia is very interesting. It's the western portion of the Tethyan Belt. So it starts, the belt starts in Romania, kind of works through eastern Serbia, through Bulgaria, northern Greece, into Turkey and the Stans. And it's interesting, although the belt is very well known and there's a lot of discoveries on the belt and it has very long history of production as well, not a lot of people focus on that western portion because it really didn't get a very good reputation politically. But by the end of 2010, early 2011, we saw that the mining laws were going to change in Serbia and in Bulgaria. And our view was that it's a district that has the geological wealth, the potential's there. It has a mining mentality, 100 years of mining in the Timok complex. And ground was available, which is very rare, right next to operations. And when you see that kind of opportunity, we just immediately jumped in and staked the ground directly.
And did you do that on the back of the reservoir minerals discovery, or were you actually doing stuff there before that?
Right. We get this question a lot. So we were actually thinking about that region around 2010, and we had hired project generators actually that were leaving Anglo in the China office. So we really had our eye on it. By 2011, we got on the ground, collected data, and then by the end of 2011, we had put in all of our applications. So it was well in advance, a year in advance before the discovery.
Wow.
Yeah.
Good for you. Okay, well, that was really to kick things off. Rather than me asking questions, maybe this is a great opportunity for Patrick to go around with the microphone and you get a chance to ask whoever you want specific questions about either the properties or more general ones about exploration.
I have a question. I have a question for Darin. You're known for the gold project, obviously, the Martinière. But what was the story for Crasse? Were you looking for base metals?
No, we figure in Canada, and we'd back Mr. Friedland up on that one. Nickel in the Canadian space is something you find when you're looking for something else. So no, the project was predicated on a gold theme. In late 2012, we had encountered a new zone of gold mineralization that had a lot of similarities to Detour. Clearly, if it's going to be Detour, relatively low grade for our space, it has to be big. So we were doing half-kilometer step-outs along the structure. One of those tagged at the bottom end of the hole, the lower contact of the ultramafic complex we were targeting. And it's at that lower contact that we started to see the PG mineralization. And really, it's a credit, the credit goes, and Graham touched on it earlier, the credit goes to the guys in the field who have the curiosity to call head office and goes, I don't know quite what's going on here. Do we have anybody in-house that knows a thing or two about nickel? And fortunately, that's yours truly. And flew out to site and sat down with the young geo on the drill and said, yeah, no, you've just hit into a magmatic nickel copper PGE system. And so the origin of the discovery is accidental. It's a testament, though, to being out there and spinning the drill. And that's really so important. It's great to talk about your concepts and all that, but you do have to have the faith to go out and test your concepts and put the holes in the ground. And sometimes you find things by accident, and that's a good thing.
Yep. Make your own luck.
Yeah. Horseshoes.
Yes, sir.
Thank you. This is a question for Theo. I wanted to know if and when she would contemplate signing a joint venture with Freeport.
A leading question.
It's a very difficult question to answer, but we are actively talking to groups that are interested in the region and see the potential and want to be there for the long term.
Everybody's shy.
I can maybe ask one while people are thinking. This is maybe the audience aren't so aware of nickel in the nickel market and some of the drivers to that.
Yeah, it's a different space for a lot of people. It's not something where there's a great multitude of names you play. Of the commodities, it's obviously had a strong year as well. And a lot of that's been predicated most recently on the ban in Indonesia. And the Indonesian government basically said no more shipping of raw materials out of our country to China, and put a ban in place on the shipment of raw nickel laterite ore from Indonesia. Basically said if you're going to mine it here, you're going to process it here, jobs for Indonesians, basically. And that's, to the Canadians, that's not a dissimilar theme. We saw that play out in Newfoundland when Voisey's Bay was discovered. And it makes a lot of sense. It's a better economic driver that way. But that basically extracted 25 to 30% of the global production out of the market. And when you do that in any commodity, you're going to see a rise in the commodity price. Some of that's been replaced by a little bit of increased production in the Philippines. But the reality in the nickel space is there's always a fairly tight supply-demand curve there. There's never a huge amount of things in inventory inside the producers or on the shelf, so to speak. So there's not things that can step into that void. So whether it be Macquarie or Glencore, the predictions over the next 3 to 5 years in the nickel space are for strong prices as those plants are being built in Indonesia. And it's predicated on just very modest global, Glencore is about a 2% global growth figure. So they're not calling on 4 or 5% growth in China or anything like that to make those predictions. So we do see, just on a very fundamental basis, extracting the emotion that is so involved in the gold space and the speculation, you do see considerable strength in the near term. And obviously our job in there is to deliver tons into that scenario as quickly as we can. And thus, a stronger focus probably in 2015 on the nickel side than on the gold side for the company.
Okay, great, thank you. Fire away.
Okay, question for Steve. A decade long now, we've seen permitting in the US get more and more challenging for mining, at any stage of mining. We've seen the US economy now where it is, and the US economy crying out for development, jobs, investments. Have you seen a change in the approach to, or the outcomes for permitting particularly in a state like Idaho, which is in California? Have you seen any sort of, I don't know, amelioration in the challenges you face in permitting in the US?
Sure. I think, not unlike, say, Canada or other jurisdictions, the US is very much locally driven. So you have to keep that in perspective as, some states are very difficult and some projects are very difficult. Obviously, Pebble is a, extreme example of that situation. But the reality of the US permitting process is it's very slow and bureaucratic, but it's very legally based. And you have the right to mine your deposit. And that is legally enforceable. And so, good example is Augusta, which has a copper project in outside Tucson. I can't comment on the merits of the project or anything, but the local county tried to stop the mine by refusing to give them an air quality permit. And Augusta turned around and sued them and said, you have no basis not to give us a permit, you have to give it to us. And the court agreed, and they got issued the permit. So you have those rights. I mean, where you get challenge is the social license side. So I think the bureaucratic process works quite well. The social license aspect of having community support or community opposition is really where you have to put the effort, because the regulators will be influenced by local opinion. If there's a huge number of people opposing and so on, they'll tend to drag the process out and make it longer and more difficult and frustrate you and send you back to the beginning. Whereas, a jurisdiction where we are, it's high unemployment. We've got, we've had independent polls done. There's about 85% support. That doesn't mean you've got 100. There will be people opposed. And it's a brownfield site. And I think brownfields makes a big difference. It's been mined for 100 years. I think that makes a big difference, whereas you contrast it to, say, a Pebble. It's a greenfield site in an untouched, pristine wilderness. Nobody's going to go to our site and stand there with a sign saying, protect this, when you've got old abandoned smelter sites and pits and waste dumps. It's not a very pretty picture when somebody looks what's right behind them. And so I think that's the big, that's the opportunity of a brownfield site, is to sort of blend that cleanup of the old site into the development of a new site. Because, just to put it in perspective, if the EPA is ballpark estimated costs well north of $100 million to clean this site up as a standalone cleanup, we're going to incorporate that all into our own design, and there's 100,000 ounces of tailing as part of that cleanup, which happens to 100,000 ounces of gold, which happens to more than pay for the cleanup of the site. So essentially you do the cleanup for nothing, and you've done a good thing. And I think that makes a big difference. So everything has to be looked at individually and carefully and locally.
Yep.
There was a wave of gold sales tonight when it became clear that the Republicans would win the parliament elections. And I would like to hear the opinion of the panel why the Republicans are obviously for a weak gold price.
Jeff, do you want to?
I guess as an American,
being a Democrat,
I'll take a stab at that. I think what the interpretation probably is, at least, and it is very interesting, the amount of gold sales that took place in the first hour, and actually it depressed the price of around $25, which is pretty unusual given the volume of gold that traded hands there, and somebody was buying it. So it's very interesting. But I think the interpretation is probably that the Republicans are going to be more business friendly. We'll make some progress on regulatory simplification, and that they will be a stimulus for the U.S. economy to continue to grow, and that is basically interpreted as strength of the dollar. And I know a lot of people in here have an opinion on gold. I am not of the opinion that the U.S. dollar is as good as gold. So it's very interesting to see the value put on this paper currency that we have. But I think that's the general interpretation, is that it's good for business, it's good for industry, and that the dollar will continue to strengthen, I think, from there.
And I think I made the comment earlier, there was a a cartoon in one of the Canadian papers, and it was Chinese people standing on one side of a fence throwing US dollars over the fence, and there was Americans on the other side throwing gold bars over the fence the other way, and underneath it said, "Who's smarter?"
I actually got that one hanging in my office.
Yeah, yeah. And, so, the US dollar is kind of the best of a bad lot kind of thing, but there's still a big reckoning there of issues that have to come forward and be dealt with.
Could we have the panel each write on a piece of paper what their projection is for the gold price in 12 months and then get an average?
As long as it's done anonymously, yes.
The one thing we'll know is we'll be wrong.
Right.
That we can guarantee.
If I knew that, I wouldn't be living here. I'd be living in Zurich where there's no taxes.
One chief executive I used to work for had a whole department who did nothing but price, calculations and predictions. And when they asked him about this, he said, "The great thing is, I know they're always wrong. They've never failed me yet." So I think that's probably. Yeah, sure.
Sure.
You can rip out the back of that.
Yeah.
Make a comment. I was at a New Orleans conference.
We're talking 12 months out?
Yeah.
I was at a New Orleans conference a couple of weeks ago, and Greenspan was there, and they really pushed him because he was talking relatively positively about gold, and they really pushed him for a price. And he said, "Look, I've been chair of the Federal Reserve for years. I know how to avoid answering a question." So they pushed him again, and they said, he said, "Higher." And they said, "A little bit higher or a lot higher?" And he said, "Measurably higher." No.
That's okay. We all have fairly strong opinions. Don't worry, we won't be swayed by each other's opinions.
There you go.
So you want the average? I'll give you the range. We'll give you the whole 9 yards for you. The range is $1,100 to $1,400, and the average of those is probably
pretty much the middle,
the middle?
Yeah,
1250.
just about 12,
Yeah, 1250. So the average is 1250.
It's measurably higher.
It's well done. Yeah.
Okay, maybe a question you can assume the answer. We're producing 3,000 tons of gold each year. And what does each of you think about peak gold?
There's no such thing as peak metal.
100% predicated on price. If your price of gold is $1,000, have you seen the peak of gold that can be produced economically at $1,000? Yeah, you probably have. If your price on the metal is $1,400, then no, because other deposits that wouldn't be economic at $1,000 come into play. So it's a little different from the oil space.
At today's prices, it will peak next year.
I mean, I think a theme that's underlying that is the exploration cycle, and there's been some charts published recently. The exploration dollars in the last couple of years have been some of the highest in the history of the industry, and there were no major discoveries, zero, of over 5 million ounces, and that is really telling, with very large amounts of dollars being put in very high gold prices, and nobody was able to make a 5 million ounce discovery. And I think that. Then you add to the fact that all the majors have basically axed their exploration departments, so the dollars are going way down, so the chances of finding something are going to be less. And the long permitting regulatory, or from discovery to production cycle, you get into these crunches, and the industry just creates them again and again because of the volatility. You create the next cycle because it will respond. Mines will run out of reserves, whether that's 3 years or 5 years or whatever, who knows. But the price will respond because there's not enough production. Gold's a little different because there's a lot of stockpile, but every other commodity, you basically see it again and again.
Yeah, and I think one interesting observation with some of the majors, it appears that next year we'll see gold production will get closer to 2,500 tons. So a lot of gold production is coming off the market out of just the age of the operations, the drop in the average grade of all gold produced. Like in Nevada right now, the average grade of all gold that's in production in the state of Nevada is 0.5 gram. And that's pretty shocking number when you think about it, that there's very little money made at $1,200 or $1,300 gold if your grade's 0.5 gram. So it's quickly going to get to the point where I think supply and demand will be a fundamental in the gold market in the near future. And as you say, a new project to come online now is 4 or 5 years away if it's well advanced right now. And I just heard from the Anglo Gold Group that they're cutting their Greenfields exploration to 0. So that's there goes some of your exploration.
Is this on? Okay. Along those lines, and just another game kind of thing. If you were not doing what you're doing right now, this is a question for each of you. If you were not doing what you're doing right now, but you had the knowledge and the background that you have, and someone would come up to you and give you a hypothetical, measurable sum of money, would you go for Greenfield or brownfield, and why, in like 2 sentences?
For me, the answer is easy because it's what I enjoy doing, and that is the Greenfields end. And from the investment center, higher risk, higher reward. But for me, the answer is really simple because that's the end of the business that I enjoy. I enjoy making the discovery. I enjoy getting up every morning and seeing what came out of the drill last night, seeing if there's something new and different there. So it's very much a personal answer. From the investment point of view, high risk, high reward. And I think you touched on a little bit earlier, we're inherently gamblers in the space. So,
Darin, you probably like fishing in a river, right? I'm much more in favor of shooting fish in a barrel. You get the food way easier, it's way less effort. So I'm a brownfields guy. I've been involved in 3 projects that have turned into billion-dollar organizations. They were all brownfields. You know, just to talk about one and just to illustrate, we bought a copper mine, which a major sold us, a copper project, I should say, and it had one single deposit, and they sold it on the basis categorically there was no potential for any new discoveries on the property. They'd worked on it for 20 years, there was nothing else there. We motivated our exploration manager and said, you get 1 hole every year, and you get $100,000 bonus if you find something with that 1 hole. We found 9 deposits in the next 4 years.
Or 1 deposit 9 times.
All different. Yeah, so, you know, so just illustrative of brownfields. I mean, that's shooting fish in a barrel. You know, it's only a property was only 2 or 3 kilometers across.
Yep.
And I do love river fishing.
Yeah. Oh, just find it easy.
I'm definitely Greenfields. And as my wife says to me, she goes, this is your Indiana Jones. You are a treasure hunter, and that's what you'll always be. So very good analogy, I think. You know, once you're a treasure hunter, it's hard to give it back up again.
I would say I look at things from a value perspective. And right now in the industry, we are generally trading at around $25 a resource ounce for things that people have spent millions, if not, you know, hundreds of $1 million on exploring for. When you have that kind of evaluation versus the amount of money it takes to actually find deposits, which there's been some really great data mining statistics on. And right now, the industry average is around $49 a resource ounce. So from that perspective, I would definitely go for buying assets right now. Exploration is important, and we're all talking about exploration panels. But if you look at it from a perspective today, what's going on in the markets, you should be buying ounces.
And I'll just say something different just for the sake of it. If you get the right acquisition at the right time and you have people who can recognize the blue sky, the capability of value add is enormous. We bought a copper operation in Chile in 2002 for $1.2 billion. It was the biggest deal that had ever been done in Chile. Fast forward 10 years later, and the value of that was $22 billion. And the resource base went from about 10 tons of copper to nearly 100 million tons of copper. So you can be successful doing greenfields, you can be successful doing brownfields, you can be a treasure hunter, you can be looking for value in this part of the market because you can buy cheap ounces or cheap pounds of copper. But you can also do acquisitions when you recognize the blue sky, and that's where the treasure hunters come in. Yeah.
If we stay in a low metal price environment for the next few years, just as an assumption, where do you see the most beneficial value proposition? Is this rather being to prove a bigger or massive resource with a high capital that has some scale over time, and if you realize it, then it's less dependable on price? Or is it rather proving a smaller resource with a low payback period and get the cash back for the investor immediately, probably like 2-3 years? Where do you see this whole thing going on in the industry if we stay where we are, where investors can make or demand the best return in a short period of time?
I think if you look right now, the appetite, and we're talking about that environment, the appetite for the funding of large CapEx operations is basically zero, unless it's a truly exceptional asset. So I think what you're looking at in that metal price environment, the most beneficial scenarios, or at least in a modest time frame for the investor, are higher margin. Whether that necessarily means smaller or not, I don't know. But building, going out to build an Osisko today, a Detour today, you don't get that money. So you're looking for things like Stephen's working on, where you can see the higher margin, smaller capex, quicker path. Recognizing that the path to getting you that $1 billion to build the massive open pit is either going to destroy the valuation of for your shareholders for a protracted period of time, or just simply is not going to be there. So that would be, I guess that would be my take, is in this environment you're looking for those higher margin, maybe lower capex opportunities, and you're putting the exploration, the bigger ones, into your pipeline on your exploration side, but probably not being able to develop them in the near term unless they're truly exceptional assets.
Where I would say, from my perspective, and probably because partly where our project is the value is to get it permitted. Because the biggest challenge in the industry today is the regulatory process, the timeline. It's not that that you don't get permitted, it's just the time it takes. And the problem is the time is extended so long now that you miss the cycles. The metal price goes up, you start permitting. By the time you're permitted, the cycle's over, and you can't afford to build a mine, you can't get the capital. So it's being ready when the next cycle goes with a fully permitted, big, good grade deposit. You're going to get value one way or another. Either you're going to get the money to build it, like an Osisko who is in the right place at the right time, ready to go, or somebody's going to come do it for you, and they're going to take you out. So it's getting it that ready to go, fully permitted, drilled off, defined, feasibility finished, and you're ready to go for the cycle, because that's huge leverage, because you can start going and building it right away.
Yeah, I think an observation I've seen just recently over the last, say, 18 months, in particular with our project, which is a low capital development project with high margin, we've seen interest level in our project come not only from junior and mid-tier mining companies, but now coming from major mining companies that truly do not have the bandwidth, the Newmonts of the world, to build billion-dollar projects anymore. And when you're sitting there with a project that's 100, 150 million to get up and running, they're interested from the standpoint, even though it's producing 100, 150,000 ounces a year, which 3 or 4 years ago would never have got on the radar screen. They're looking for these high margin opportunities now, and that's coming all the way down market to groups that are like Anglo Gold or Newmont or even Barrick. Now it's all about margin. And ounces, these companies are going to produce a lot less ounces in the future, but they need to produce ounces that are going to have margin. And that's what's important for them now. And, you know, I think that'll be a very important aspect going forward for groups like ours as we go through the next 2, 3, 4 years. You know, maybe 10 years from now when gold's back at plus $2,000, you can do the billion-dollar projects. But I think right now margin is everything and low capital.
Yeah, at the risk of repeating everything that's already been said, maybe putting it in the context of a lot of the companies that are out there in the market. So just in Canada, for example, we have 2,500 plus companies. Now, the majority of them are in exploration and looking to generate value and interesting deposits. But at the end of the day, one of, I think, the biggest mistakes of our industry over the last decade is that they've tried to grow for the sake of ounces. So if those ounces were expensive, it didn't matter. We were going to grow those ounces. Production was going to go up. We can promise shareholders we're going to deliver, you know, 20% more next year or 10% more. And that has killed the reputation of our industry. It's made us look like an industry that doesn't understand margin or value. So I think part of the problem is going to be the solution in the future. Mindset has actually changed, and hopefully that'll trickle right down to the junior companies who are not going to go for those, you know, big, low-grade, tiny, really in the middle of nowhere projects. You really have to think about infrastructure, you know, what that grade is. And really, at the end of the day, what makes a project is grade. That's going to ride you through the cycles. So think of projects with real grade and real margin.
Yeah.
The days of ounces are us is over, folks.
Yes.
Yeah.
Grade is king has been around a lot longer.
Absolutely.
I would like to challenge Jeffrey on your statement before, in the sense, how does supply demand matter at all? Because you basically made a reference, supply might go down, and this might be a wake-up call. But as we can observe over the last 1.5 years, it doesn't matter at all. So it's not copper, it's not zinc, it's not nickel, where the industrial demand drives the price eventually, depending a bit the inventory situation. So why do you reckon that in the near future supply demand in gold on the production side does actually matter?
I think it's important to look at the fundamentals of the gold market. We saw a lot of gold come into this market over the last 1.5 years, and that was gold that was available in ETFs, COMEX contracts. We haven't seen the central banks, which are the real gold supply that's out there in the market, that if we have 3,000 tons of consumption a year and 2,500 tons of production, that 500 tons is typically, over the last couple of years, has come through the ETF or the COMEX accounts. Those accounts are, you know, in a situation where a lot of gold has been redeemed on those. And a lot of that gold has been purchased by people that are demanding delivery of the gold as far as physical bullion. And I think we're going to quickly get to the point where the deep pocket for gold bullion availability in the marketplace is the central banks. And we haven't seen the central banks get into a selling mode lately. It's usually, you know, my experience over the last 10 years or so is when gold's down, central banks like to sell. So we haven't seen that happen yet, and it's interesting. And so I believe fundamentally we're drying up that really liquid availability of bullion. We're seeing a lot of physical demand going to China and Asia, where they're not buying COMEX contracts, they're not buying ETFs accounts, they're buying physical bullion that they want delivered to them. And smart idea, in my opinion. We'll see what happens, but I believe there eventually will be a squeeze that will happen when we can't match production with demand. And I think a little bit of acceleration on the demand side from the generalist side And we're going to get ourselves in a pretty interesting short squeeze on the gold market. But I could be wrong. The central banks could fill that void easily. They certainly have enough gold to do it. It's just what's their fortitude about the future. And I love things when Switzerland's talking about voting on acquiring a lot of gold in the future. Granted, it's probably not a possibility, but it is a great thing to talk about, at least in the sector.
So what about Keith Neumeyer's idea, the CEO of First Majestic, to just not selling everything, every gold, every silver produced, so to hold it back and influence the price in this way? What do you think about that?
I've commented, Rob McEwen really pushed that, back when he was running Goldcorp, and he did hold back a big chunk of his gold, and he got no credit for it. And of course, when they combined with Glamis, it was all undone, and that gold was sold off. But I think part of the challenge is that the gold mining companies aren't making any money at the moment, so they can't hold any gold back because they're not total cash positive. So they, with the debt, when you add the debt payments and so on, so they're not really in a position. But as philosophy, I think Rob McEwen had the right idea. You're a gold company, you want exposure to gold. If you don't need the cash, keep it in your safe as gold.
Many of us remember the price of gold at 350, and many of us in the room would rather not remember it. But could you give your views on what would have to happen for the gold to go back to $350 an ounce?
I don't know. Don't want to think about that. But I remember when gold was 258, and we bought a project called Hope Bay from BHP, who sold right at the bottom of the market. And we bought it for $18 million, and 7 years later we sold it for $1.6 billion.
And I have a memory of the Bullfrog operation when it was operating. It had the glorious distinction of operating through a period of time when gold was $240 to a maximum of $400 an ounce. Open pit operation, exactly like what's going on in Nevada now. And they were making, and their cash cost for production was under $200. So there is a will and a way to get it done. I think you're going to have to see oil back at $8 a barrel. You're going to have to see a lot of things that are going to shock the world if that would happen.
Mm-hmm. I remember in '99 when gold hit 250, and I was working in equity research at the time. And obviously, you're looking at all the companies that you have recommendations on, and gold is at the bottom, and the traders and the sales team don't care if you show up at the morning meeting because nobody loves gold or the precious metals in general. It's the reason why we had such a low gold price was because genuinely there was complete disinterest in the commodity. And I have a differing view than yourself on supply and demand. I really don't think it's a supply and demand issue. It's a currency issue. And the more negativity there is in the U.S. and the U.S. dollar, gold will do well. And the opposite of that, you'll have a floundering gold price as we're seeing right now. So if you believe that the U.S. is going to do extremely well over the next 5 years, and the Western economies will do extremely well, and that growth will grow, and that the general broader markets are going to continue to outperform, I think we need to be prepared for lower gold prices during that kind of time frame. So that's my view on it.
And that just means there's a premium for quality. Mm-hmm. So where there's a challenge, there's an opportunity. And it's all about the grade and the quality of the assets. So good assets will always make money, but they'll have a premium because there's not many of them. And if you're in the selling your assets business, you can make a lot of money, but you can also be developing those assets if you're a miner and making good margins. So it always comes back to the quality question.
Mm-hmm.
And I think as well that gold price does reflect inflation, and inflation is impossible to measure because the stats don't really seem to mean anything. But, you know, you go back, as you said, when gold was 250s, you know, fuel price was dirt cheap. Well, fuel's $80 a barrel now, so it's 10 times the price. Yep. You know, gold isn't 10 times the price. So that squeezed the margin. So, and it's not just that, it's when you buy trucks or sag mills or steel or concrete or, you know, all of those things. So that's what's really, you know, hurt the industry is you've seen the underlying cost, labor is another major component that's really gone up a lot. You know, it's backing off a little now, but it's all those costs are squeezed up. And yeah, gold was going up and going up a little bit faster, but now it's down. That margin is pretty much evaporated. And you know, I wouldn't characterize it. I mean, there's definitely bad practices in the industry, and there've been some, you know, poorly spent capital. But a lot of it is uncontrollables. You know, the cost of steel or you know, mining trucks or whatever it happens to be, or fuel, you have no influence on it, and you have to deal with it. And without the price to gold responding, it creates real margin pressures, and that's why you want quality, grade.
Well, I had a very interesting discussion a couple weeks ago with a major senior management member in a major mining company, which I will not name, and they said, at $1,350 gold, our company has an NPV value of about $7 billion. At $1,200 gold, we have an NPV value of 0. That is the implication of debt, it's the implication of legacy costs, it's the implication of all the things that the industry has built itself up for right now, following those curves as they went up. And it's going to be a rough patch to go through for the gold industry, the producer side, if we stay at these gold prices for another 12 months. It's going to be really difficult for a lot of companies.
Yeah, so I think in answer to your original question, how would we even get there? The only scenario that really, the scenario that would have to play out to get you there would be a dramatic failure in the Chinese economy, which would see them liquidating the US dollar currency reserves. And I don't think you can go back there. That's a genie. Hopefully we will never see. I don't even think you can get there at that kind of level. Could we see, could we see it short periods of time lower than what we're seeing today? Absolutely. And that may be coming at us. But, as everyone else was touching on, the fundamental costs in the industry, if you're going to continue to pull metal out of the ground at all, you can't see 350 again. The costs just don't let you see. Let it happen.
A while ago, I remember, I think in mining it was a lot about large resources, blue sky potential, all these, beautiful things and fantasies. And afterwards, with the liquidity squeeze, it came about getting things financed, exploration difficult. And so then the cost side, I think the mining industry is often a little bit rather trend followers. And which do you think is the next big thing, being rather avant-gardist? Which will be the big thing which really makes it or not?
How about we make you some money? How about the industry actually sit down and the major producing companies actually turn profits? I think if that's the focus, and it's, Graham pointed out earlier, you have a big change over in the CEOs of vast majority of the majors, and that focus has shifted to the bottom line, which is where it should have been. It never should have got to ounces or us. So, what's the next trend? The trend has to be, for the industry to be successful, the trend has to be to making profits. It has to be a business. It can't be a churning of paper or a churning of gold through the system. That has to be where it goes. It doesn't have a choice anymore.
Did you ever think about bringing really money back to the investors?
That's what we're supposed to do. That's what the producers are supposed to do. Certainly on the exploration side, we return that through the share price. But the producers are supposed to return it to you through dividends, through growth in capital, and that's what's not happened. That's been the fundamental flaw in the space. We got so in love with we're going to produce more, and that on that marginal bit of money we're making on every ounce, we're going to build, we are going to make more profits. That's not good enough. It has to be this. And so, I mean, you've harped a little bit here on quality. That's where the industry has to go. If that means less ounces produced a year, to go back to your peak gold question, that's where we have to go. Far be it for the exploration companies to be preaching to the mighty producers, but they damage us in the process as well. And we've all dealt with the fallout. The investors have, the companies have, our access, the restrictions on our access to capital, because we haven't, as an industry, made people enough money. And that's what business is about. It's about making people money. And that's where the focus, and the changes we've seen at the heads of the majors are predicated on the fact that the boards of those companies have gone to management and said, you're not making us enough money, you're out of here. Or as Mr. Trump would say, you're fired. So, my 2 cents anyways.
Is that us? Yeah, well, thanks very much everyone for your questions, and thanks again to all the panel members for sharing their experiences, and I hope when you leave this evening you know a little bit more about where exploration fits in the mining industry than maybe you did a couple of hours ago. So thank you.
Thank you.